Starting the event takes 15 seconds.
Oh, you know the timer, do I start it when you start answering questions?
Start it when I get into it. Okay. Good morning. We're going to start in a couple of minutes. Just let everyone get into the webinar. Welcome to Fusion. Good morning. We're going to start in a couple of minutes. Just let everyone get into the webinar. Hope everyone's had a good week and getting all prepared for the budget and what surprises it's going to throw us in the coming weeks. Just going to give it a couple of more minutes. Everyone come in. I can see there's quite a few people already here, so welcome. I'll start the introductions in a moment. Thank you for your patience. As I said, today's webinar is going to be about preparation for the budget, the things you should be doing early, and the things you should really consider not doing, which is quite fundamental, and we'll come into that a bit further soon. It's nice to see quite a few of my clients have joined, which is great. Hopefully you're already prepared for the budget based on discussions we've already had. But if not, there'll be things you'll pick up in this webinar, which we're going to start in a few seconds. Okay, everyone. So welcome to Fusion Consulting Group. My name's Neil Jacobs and I am the head of Fusion Financial. And today is all about preparation for the budget, which is going to be on the 26th of November. What things you should consider doing early and what things you should really put off until you know more. As a lot of you already know, Fusion Financial is part of the larger group, Fusion Consulting. Within the group, we have accounting, we have tax, we have an international department, we have a recruitment department. We also have a consulting team that assist a lot of our clients, and we have the law. I represent Fusion Financial. My name's Neil Jacobs, and today, as you well know, we'll be discussing the budget. In this webinar, we're going to really take a moment, think about what things are going to come up in the budget and how we can prepare for them. Try and offer a level of calmness to that so there's no knee-jerk reactions. We'll also look into property and income taxes. I'll also want to look at guiding my clients on behaviours they should really put into place and really avoid those knee-jerk reactions which can sometimes happen. And we've had experience of clients ready to shoot the bullet a bit early, and my job is sometimes to just prevent that happening. We'll also look at planning framework, pre and post budget checklist. And then at the end, we'll be able to go through questions and answers. Please use the right-hand side in the chat box, put any questions you have there, and just feel free to ask anything there, and I'll probably end up answering them at the end. Also, you can see at the top, there's a link. Welcome to use that link, whether you're a client or not a client, to book some time in my diary to have an informal chat if there's anything pertinent you want to discuss about the budget or anything outside. That's going to be there for the whole presentation. Feel free to use it. think I've already said this, so we'll skip this one. I'll tell you a bit about myself, though. So I've been in the profession for well over 25 years. Previously, before Fusion Financial, I headed up my own financial planning company, which I brought into Fusion Financial, and now I head up the department here. We've got a fantastic team within Fusion Consulting, and Fusion Financial is made up of a couple of advisors. We have an administration team, a paraplanning team, and operations. And together, we work really hard in making sure that our clients are well looked after, get good advice, and help them achieve their goals and aspirations. Obviously, if you want to learn more, press the link at the top, have an initial discussion with myself or one of my team members, and see where it goes. So as we well know, on the 26th of November 2025 is going to be quite a significant event for savers and investors and even people in retirement. There's many rumours out there that we hear about ISAs, pensions, IHT and more. And I would say it's really vital not to make those knee-jerk reactions which I've seen in the past. Speculation's rife, and you need to be informed to make the right decisions. Acting too soon can really damage all that planning clients have done. A perfect example of that is if there's not a need to take money out of one's pension, the tax-free cash, pre-budget, then don't. If we don't know what they're going to do about the tax-free cash, making a knee-jerk reaction and taking the money out of a tax-efficient product too early could damage all those plans you had for your retirement. If, on the other hand, there are good reasons to take that money out early, on a personal level, added to the concerns a client may have, then it may be something worth considering. But it's about being informed, having a good idea of what you're doing and what impact it may have post-budget. Key message here is really don't get too influenced by the newspapers, the news. Keep informed, have an idea of what your options are, and take it from there. So, like I was saying, pre-budget, we know that there's going to be some impact potentially to the ISAs. We hear rumours that they may be getting rid of or reducing the cash ISA allowances. We hear there could be restricting salary sacrifice, which means it's going to be more costly paying into one's pension. We also know that there may be changes to capital gains tax, and inheritance tax is always going to be an area that's going to be reviewed and how they can really start focusing on targeting more of the population on that. We've already seen pensions be brought into the IHT world from 2027. So we know that that's going to impact things. And we also have seen over the years capital gains tax reduced all the way down to £3,000 a year per person as an allowance, which is really not going to make much of a mark in terms of tax planning. It certainly made it harder, but not impossible in terms of utilising ISA allowances from other investments. You can just about do it with a 3,000 allowance, i.e. moving money from a normal investment into an ISA and building up a tax-free investment over time. The biggest concern I would say here is on your pensions. So again, think about pre-budget. Do I really need this money now if you are post-retirement age? And if there is a strong reason, then one may consider it. But while your money is in the pension, obviously one should really consider keeping it there where it's growing tax-free. And over the time you have left until you really want to use that money, you'll probably make more. It's likely that any changes that do kick in aren't going to happen overnight, so it will give you time to reevaluate and put a plan in place. With your capital gains, obviously it's about really making sure you use your allowance, what allowances we still have. And within IHT, we'll come to that, but it's about, are you making use of all your annual allowances? Is there stuff that you're not benefiting from now that you could potentially pass over to other family members? Now, this is an area that has been targeted in so many budgets in the past, and it's a strong possibility it's going to get targeted this year. We see potential changes to stamp duty where they discuss mansion tax and even an annual tax on high value properties. We don't know how that's going to look. It's far too early. We also see for landlords that are benefiting from rentals that there's a possibility of national insurance being forced on them and having to pay that on the income. Also, changes to the income tax. A threshold freeze is basically a way of, because inflation's going up and potentially you're increasing your rents on your properties. If they freeze your effectively tax-free allowance and don't increase that, effectively they're going to get more tax out of you anyway. So I would say this is a really concerning area for a lot of people. It's already impacted the buy-to-let market over the years, even from Conservative and the changes they've made to the area. It's really important, once we know more about this, one needs to sit down and think, why have I got these properties? Is it for a balance between capital appreciation, property value, and rental income to live? Or is it just total capital appreciation, or 100% I need the income? For people that really need the income and want to benefit from the most tax efficient way of deriving an income, then post-budget, once we know more, that's the time to really reevaluate, is this property portfolio meeting my goals and aspirations? Yes, there are consequences if one needed to pivot and make changes, i.e. capital gains. But if the client or the individual is really focused on income, is the property portfolio as 100% of your income or a large proportion really the best way going forward for you to derive that income? Are there other options you can incorporate into your strategy going forward? So I'm not saying one needs to totally move out the property portfolio for the income, but is it worth looking at other options and incorporating that within the strategy? In regards to the property side, if they start putting a levy on high value properties, then obviously that's going to impact people's considerations on what value of property they're willing to buy because of the impact that may have on their annual disposable income. We still don't know much about this. It's still something they've discussed, and obviously something that you will need to reassess post-budget once you have a better idea. Salary sacrifice has been a really useful tool for employees and directors to get money out of the business or potentially from their salary pre-tax into their pensions. So I would say that is something we'll talk about, and an area that is definitely worth considering looking at further down the line. This is where I would say, and I brought it up earlier on, don't have a knee-jerk reaction. Consider how these changes may impact you post-budget. Consider your options, and if there's not much downside to those, then it's worth doing early. But make sure you're informed. We don't know what's fully going to come out in the budget. We know what things have been considered. So at this stage, there are things that are definitely worth doing now, and there's going to be options on the table that are worth just pushing down the line post-budget and making those decisions once you're far more informed. History has shown myself from the example I showed earlier on pensions that panicking and making that reaction and making drastic changes to your planning may harm you further down the line. So if you've already got a financial advisor, sit down with them, look at what your options are, take time yourself to reconsider them, and put a plan together on the things you can do now, pre-budget, which we'll come to, and options to consider post-budget once we're far more informed and know what's going to be coming down the line. Now, before the budget kicks in, we all have a pension allowance for contributions, and we can even go beyond that using carry forward rules. So one thing that's not going to harm you as a investor is utilising your allowance pre-budget, which is £60,000 a year per individual, and paying that into the pension now rather than later on down the line. Obviously, you need to consider, is it affordable? Will it impact your business? But for some individuals, if it was something you were considering anyway, it's definitely a positive to do that now and build up that pension pot. For certain individuals, salary sacrifice, if that's an option to make those contributions into your pension, it makes a lot of sense to do it because effectively the money will go straight into the pension, no tax to pay. With your ISAs, I personally not that concerned if they make drastic changes to the cash ISA. As an advisor, when we look at putting a plan together for clients, cash is there for a rainy day. The cash ISA is not going to make you potentially great returns over the medium to long term. So as part of your overall portfolio and strategy, cash is there for taking advantage of an opportunity for some individuals. And for most people, it's just there for a rainy day and make sure effectively you've got money put aside if something happens and you can get to it readily available. The investment ISA, which hasn't been much of a focus pre-budget, is there for medium to long term, to invest, to earn potential growth. And while it's in the ISA, it's growing tax efficiently. So if one's always been using a cash ISA, there's still options available to you if you are looking more medium to long term. And you can take different levels of risk within that stocks and shares ISA. So it's about looking at how much money have I got in cash? Is that too little or too much? And what are my plans in the medium to long term? Also, utilising that full allowance of £20,000 really at any stage pre-budget, if you're in that position to do so, makes sense. You do that every year. Obviously, you're building up a great portfolio within a tax-efficient wrapper where you're not going to get taxed on the growth and you're not going to get taxed on the income. There's many investors already today with over £1 million in ISAs. So when it comes to retirement or a life event, they know that they've got money tied up in one of the most tax-efficient wrappers available. You only get that allowance every year. So if you're in the fortunate position to utilise it, do it. While the cash allowance is available and you want to use that, fair enough. But the investment ISA, obviously it's best to get advice, will give you far greater potential over the longer term. As I discussed earlier, your capital gains allowance has really dropped to such a minimal amount. It's £3,000. It still has its use. If one has money in a general investment account where if you sell down, you're going to pay capital gains, this is worth selling down enough to relieve some of that 3,000 allowance and top up your ISA. So it makes a lot of sense to do so. In regards to property ownership and values, post-budget, it's going to be a lot more work involved. Pre-budget is looking at how are things now? How is the ownership set up? If it's a buy-to-let, is it set up in a company? Is it owned individually? What are the values of those properties? And really getting a good idea of where you stand now, because it's already impacted property investors, all the changes over the years. Post-budget, if it impacts them even more people are going to move out of that market. Pre-budget, know what your thresholds are for your income tax. Speak to your accountant because they are potentially going to change. When it comes to post-budget and you're looking at your pensions, obviously, when it comes to drawing down, it's something one would consider, and it's about looking at the changes to income tax and so on, how that will impact things. When it comes to salary sacrifice, really need to reevaluate what changes have been done, look at your benefits you're using, and is it worth cancelling certain benefits if salary sacrifice has been taken away and doing them privately. Really, it's a detailed reassessment of what benefits one's getting from their employer and is it still worthwhile doing it in that way. Within your ISAs post-budget, if they do action what they're threatening, definitely it's all about reevaluating your investment mix, assessing your attitude to risk, putting together a proper strategy over the term you need and running with that and utilising that allowance in a different way going forward if you've always been a cash ISA. With CGT, make sure you're offsetting any gains and losses and utilising that allowance. Hopefully that 3,000 is going to stick for a bit longer, but there are threats that obviously over time that will go. IHT's ever changing. Utilise your gifts, your annual allowances. You have an allowance of 325,000 each, plus the property allowance 175. Now pensions already included in that from 2027. Any further changes to IHT are going to impact you as an individual. So it's definitely worth sitting down and working out, where do I sit? Am I having a good life? Can I afford to start considering giving some of my assets away now while I'm alive to really reduce that bill? It's only worth doing that if it's not going to impact you as an individual in your retirement. The property one's going to be massive for a lot of people. And I think post-budget, reevaluating that strategy is going to be fundamental. Understanding the yield on your property incomes if they do end up adding national insurance to the income. What yield are you getting on those properties compared to other options of deriving an income that may be more tax efficient? Reality is, though, with properties, it's not going to be easy to pivot because you've always got capital gains to consider. So it's about sitting down with an advisor. You can speak to one of my team or one of our tax advisors and looking at what your options are and scenarios that are available to you. Another useful tool we use as a financial advisor is cash flow forecasting. Obviously, when everything changes and if they continue to add additional taxes, we'd need to reevaluate the cash flow forecasts we've done for previous clients and look at how all of these things are going to impact your income and disposable income even more over the forthcoming years. So in summary, I would say the best thing to do is be flexible, be adaptable, understand the pros and cons to all of these scenarios and changes you may have to make. Fusion will be happy to analyse your situation post-budget, looking at how it's going to impact you, and then tailor a recommendation to your requirements and needs. Avoid speculation. Plan strategically once we know what's going on. In the meantime, if you know there's certain things you can do now which aren't going to be a detriment, like utilising your capital gains allowance, utilising your ISA allowance, utilising your pension allowance, they're not going to harm you. Do it. But anything else where it's a knee-jerk reaction could potentially impact all that hard work you've done over the years of your employment. So before you do anything, if you are ready to do that knee-jerk reaction, stop a moment, click the link above, sit down with myself or one of my advisors and thrash it out with one of us to see, is this a good idea or not? I'm going to answer some questions now. Hopefully you found that useful. There's a lot more detail I can go into here. So obviously, if there's anything that wasn't brought up, then feel free to use the link, book some time in. I can see a lot of my clients are on here, which is lovely. So a lot of you have my number in your mobiles. So just give me a bell and we can have a chat over a coffee. Got some interesting questions coming up. So I'm going to have a look. So yes, carry forward rules is an option for some people. It's all about, I do apologise. It's all about making sure that you don't go above your allowance. Carry forward rules are all about pensions. If you haven't used previous year's pension contributions, there may be a possibility of doing so. It is more difficult for people to do that if they're employed and it's not their own company, because you can't contribute more than your earned income. However, if you have a company willing to contribute, they can contribute more than your earned income. So we know that the annual allowance is 60,000, but you could potentially pay in up to 180,000 into your pension if it's coming from your company. So, or if your employer is feeling really generous. ISA allowances are 20,000. Yes, you can use that between cash ISA at the moment and investment ISA. So for now, if cash is king for you, put it into your cash ISA. You can always transfer cash ISA to an investment ISA in the future. So feel free to consider that in the next few weeks. If you're sitting in cash and you know you've got more than you need, speak to an advisor. Get that money working for you. Look at what are the most tax efficient ways of having your assets work for you, and hopefully in the most tax efficient way. We know that tax rules are going to be changing. I can't answer a question on what I expect to happen on that. I'm pretty sure there'll be some freezes, and we know that's a stealth way of getting more out of us. If you fall in the bracket where you're losing your personal allowance, this is where making contributions from your employer into your pension potentially will give you some of your personal allowance back and is worthwhile doing, rather than being one of those people that end up paying 60% tax without knowing. Questions about national insurance on properties. Like, I honestly don't know if they're going to do that, but if they do that, the yield many people are going to start getting on their property income is going to really make certain individuals evaluate whether this way of driving a passive income from their property portfolio is still worthwhile. We have seen many individuals reduce their property portfolio over the last 6-7 years. It's still a good asset to hold, but I would say definitely these days it's a good asset to hold alongside other more tax efficient strategies. So post budget, look at your property portfolio, sit down with your accountant, your financial advisor, your tax advisor, and look at how these new potential changes are going to impact the income you're going to receive from these properties, and evaluate what other options are available to you to consider, which will help you reduce your tax bill. In regards to us Londoners, if they're going to add a mansion tax, which could even be an annual tax, it's too hard to really comment on that at this stage. It's really going to depend on what they call a mansion. As we know in London, a mansion doesn't cost £1 million. So it's going to be a large impact to the southeast and other big cities, even Manchester. So it'll be interesting what they're going to do in that area. And then obviously us as owners and buyers of our homes will be considering what can we stomach and what is going to work for us as purchasing homes. We'll have to really reassess that once the information comes through in the budget, and I'm sure we'll be sending out material post-budget with our evaluation and provide stuff on that. I think that's the main questions I've had so far. Just going to see if anything else comes through. Give it a moment, and then we'll take it from there. Just having a look. Okay, so I would say a really useful tool for anyone is cash flow forecasting, post-budget, pre-budget. Sit down with your advisor, ask them to complete a cash flow forecast. Within that, we can look at scenario planning and how it's going to impact potential growth of your assets, your income you're going to derive, and we can stress test it. So it will really help you as an individual be more informed of your financial position. And what we know is the more informed you are, the better you can make those decisions. So as you know, my name's Neil. I'd like to thank you all for joining us today. All of our contact details are on the screen. Please, if you want to book some time with me, it's complimentary. Use the link above. Feel free to do that. Love to have a discussion. We're based in North Finchley, so if you're local, you can always give us a call and book some time in and pop into our office. And I will hopefully put some material together post-budget with feedback on what we would be considering to do. Thank you for your time today. Have a good end to the week and enjoy the sunny weather out there, even though it's fresh.